Have you ever wondered why your home insurance premium seems to change sometimes, even when nothing about your actual house or your personal situation has changed? It is a common question, and the answer often lies for beyond your front door. You might also wonder why your neighbor pays a different amount than you do for similar coverage. It is truly fascinating how many external forces influence this. The broader insurance market significantly influences your home insurance policy pricing by responding to large-scale trends, overall economic conditions, and collective risk data. This means that events happening hundreds or thousands of miles away, or even global financial shifts, can directly impact what you pay to protect your home. The core mechanism behind this influence is called the underwriting cycle, which dictates periods of hard and soft markets. When there is a series of large-scale catastrophic losses, like hurricanes, wildfires, or severe winter storms across a region or even globally, insurance companies have to pay out massive amounts in claims. To replenish their reserves and prepare for future risks, they often increase premiums across the board. This is a primary driver, as the cost of these payouts directly affects how insurers assess future risk. Furthermore, insurance companies themselves buy insurance, known as reinsurance. When global losses increase, the cost for primary insurers to obtain this reinsurance also goes up, and these increased costs are then passed on to policyholders like you. Economic factors also play a critical role. For example, when interest rates are low, the money insurers invest from your premiums earns less, so they relying more heavily on underwriting profits, meaning higher premiums. Conversely, higher interest rates can lead to better investment returns, which can sometimes temper premium increases. So what can you do when the market influences your rates? First, shop around regularly. Do not just renew automatically. Obtain quotes from different insurance providers every 1 to 3 years. Second, truly understand your policy details. Knowing exactly what you are covered for and what your deductibles are can help you make informed comparisons. Third, ask about all available discounts. Many insurers offer reductions for things like bundling policies, having security systems, or for a claims-free history. Lastly, maintaining your home and mitigating risks, such as updating an older roof or improving drainage, can demonstrate to insurers that you are a lower risk, potentially helping to offset market-driven increases. This interaction of global events, economic shifts, and local risk assessment is guided by the sophisticated field of actuarial science, where professionals use complex statistical models to predict future losses and set appropriate pricing. The market is constantly adjusting, moving through what experts call hard markets with higher prices and tighter availability, and soft markets with more competitive pricing. We have been experiencing a harder market in many regions recently due to increased frequency and severity of natural disasters, making this understanding even more critical for homeowners. By grasping how these larger market forces interact with your individual policy, you gain powerful insight into why your rates fluctuate. This knowledge empowers you to proactively manage your premiums, confidently navigate your insurance choices, and ultimately secure the most suitable and cost-effective protection for your most valuable asset, your home.